Hello, everyone. Firstly, thank you so much. A warm welcome on behalf of AIF and PMS Experts India. Thank you for taking the time out and joining the call. With me, I have Sankaranarayanan Krishnan. He's a quant fund manager at Motilal Oswal AMC, and he brings about almost a decade of experience in terms of managing quant strategies in various organizations. So he's an engineer from IIT Nagpur, did his post graduation MBA from IIM Indore, and he's worked with large organizations like Morgan Stanley, where he was managing quant. So all his life, he's been into quant management. Managing funds both with help of technical analysis as well as fundamental analysis. I would say a very healthy mix of looking at various parameters and then investing. So today I thought I'll invite him and we'll read his mind, try and understand what is quant fund management first of all. How do you manage money with various parameters which are predefined and generate alpha consistently. So that is one aspect that we want to learn from him, and at the same time we'll develop on the strategy that is been launched by Motilal Oswal, the AIF, and then we'll kind of get into the other questions and we'll open the forum for Q&A as well. So I don't have to sort of introduce Motilal Oswal. So all of you know Motilal Oswal as an organization has been into existence for over 3 decades now, and asset management piece was started in 2002. So they have almost 2 decades of very, very strong, consistent track record in terms of managing public money under the AIF and PMS platform. In fact, in AIF, they are one of the largest managers in India. They've collected about more than 5,000 crores in last 2 to 3 years time, and that makes them one of the largest managers in terms of managing AIF money in India. So we'll not get into too much of detail without wasting time. I'll come to Mr. Shankar Narayan directly and ask him. So over to you, Shankar Narayan. Just wanted to understand. The first question that I had is because at AIF and PMS Experts India, we keep organizing these knowledge-based sessions for our investors. So idea is to make them empower with a lot of knowledge and wisdoms that you bring on the table. And of course, they will have few questions, so which will take them once you are done. So over to you.
Absolutely. Thanks a lot. Thanks for the warm welcome and good afternoon, everyone. Thanks for taking time out on a Friday to listen to what I have to say here. If you have any questions at the outset, maybe we can answer one or two questions, and then maybe I can start talking a bit more about what is the exact fund that we have put together. So if you want to go with that kind of a format, that makes sense. Or if you want, we can do it the other way, where I first talk about the fund in general, and then we can take questions all in one shot, however you want.
Yeah, so the first thing is that, Motilal Oswal as an organization, they're known for fundamental analysis and
Correct.
long-term investing, which is buy right and sit tight. At
Correct.
the same time,
Correct.
this quant is something which is newly built strategy, I would say. So first, before getting onto the strategy, if you can throw some more lights on, as I mentioned, how does the quant fund management works across the globe, not talking about India, and
Right.
how has been your experience, and then we'll come to the strategies.
Perfect. So quantitative fund management is actually a catch-all term, right? By that, what I mean is it can mean various things for various people. Someone who's following a very, very simple system, which says, I will buy every time the current price moves above the 200-day moving average and sell every time it crosses it from the up below. I'm going to sell it. This is also a system. Okay. And it is called a quantitative system because there are some numbers behind it. Now, something as simple or straightforward as this is also a quantitative trading strategy. Then you can go all the way to the other end, where you can keep adding complexities of various levels. So you can keep saying, okay, I don't want to look at different managers can have different strengths. right? So some people can be more sound in their fundamental understanding of companies, whereas some people may be more well versed with the technical side of things. Personally speaking, I'm more comfortable with the fundamental side of things. So the only I wouldn't even call whatever statistical data I use as technical analysis, because I use more statistical patterns as compared to the more common technical strategies which are available out there. But having said that, there is no rule which says that only statistical parameters can be called quantitative strategies, technical parameters cannot be, or only fundamental parameters can be called quantitative strategies and the others can't be. So anything that can be quantified, okay, and a rule can be designed around it, no matter how simple or how complex, is a quantitative strategy. Okay, so today we are actually in a day and age where there are a lot of up and coming fund managers who are not going by any prior information, any prior knowledge. They are just saying, okay, there is just so much data in the world in a structured format as well as in an unstructured format. I want to throw all that data to a system and let the system decide what is the best possible allocation.
Sure.
Which is the extreme right end of where things can potentially go to. The extreme left end is like the simplistic signal that I first spoke about, where it's basically relying on one indicator. Reality, perhaps, or perhaps the most concentration of quantitative fund managers in India as well as in the world, lies somewhere in between these two extremes. So that's essentially what the lay of the land is. And it's in India, it's of course a more nascent place. Larger asset management companies, uh, especially ones who have presence in the mutual fund space, such as ourselves and guys who are maybe our size or slightly even larger than us, are just about entering this system. Uh, because the hurdle rate for us to kind of, for any firm like ours and similar firms like ours, is a lot higher in terms of finding conviction with these strategies, as opposed to someone who is starting out. Because for someone who's starting out, they can afford to be more experimental in nature. As a result, you don't see a whole lot of large assets being managed by these strategies in India currently. But globally, it is a huge space. It is so big that, factor-based investing, which is just one subset of quantitative investing, is already close to $3.5 trillion in assets. For perspective, that's larger than India's GDP. Right? So that's how big this space is.
Oh,
That's how much well established this space is in the global context. So if you talk about incremental flows on a year-on-year basis in the US, 30% of the incremental flows on a year-on-year basis actually go into these strategies. It has now become the second largest category after broad-based index funds within equity investing. Right? So that's how big these strategies are in the US. And quantitative strategies can trade not just equities, they can trade commodities, they can trade currency, they can trade fixed income. The underlying does not matter as much, because ultimately you're looking for some form of causation patterns, whether it is on fundamental data or statistical patterns or technical data. But ultimately you're looking for some overarching pattern in the data. So long as there is data, there is no distinction to be made as to whether that data series belongs to equities or the data series belongs to fixed income or currencies. So long as it is relevant for that particular asset class, a quant system can be run on that. So essentially, that's how the industry is structured.
so how does it work? Like, for example, I mean, there are various portfolio managers, and everyone have their own set parameters, as I said, the
Correct.
defined statistics, the patterns that they look at. And of late, in India also people are talking about artificial intelligence, machine learning coming in place. So how different is this from them, or it is the same thing? Can you throw more lights on how does it work?
Yeah. So basically, see, at the end of the day, it's like the question is very simple, similar to asking if there are 10 discretionary managers. Okay. When I say discretionary managers, I mean people who manage money, where they are projecting forward data, they're meeting managements, they're taking a lot of subjective discretionary calls based on their own judgment and analysis of companies, where not everything can be quantitatively defined. I don't mean to say a discretionary manager is someone who only goes by their gut and takes decisions on an ad hoc and random basis. That's not at all my point. Uh, a discretionary manager is someone who uses data for sure, but ultimately also exercises their judgment, right? So, and that has been the history of fund management or investment management globally as well as in India. So the who's who of the fund management industry, the more popular ones out there who are very, very successful, are all discretionary managers, right? So if you ask them the same question, so how is fund manager A different from fund manager B, and how is fund manager B different from fund manager C? It all comes down to the process that they follow. They may follow different processes and may perhaps end up with the same set of companies or very similar set of companies in their portfolio, but they follow different processes. That is important. The company that they form in their portfolio is just the outcome of the process that they follow, right? Similarly, for various quant fund managers, different people can form different processes. So I can have a bias towards quality, and for me, with quality investing, and for me, quality of a company can be defined using, let's say, 10 indicators like return on assets, return on equity, return on capital employed, and blah, blah, blah. For someone else, it can be defined by very different indicators. So they can perhaps only look at debt to equity. Perhaps they can look at how much cash a company is generating. They can look at how much new investments the company is making, how aggressively it is acquiring new companies, and so on. Right? So both these definitions are perfectly valid, but they are not the same. And the third point is someone can think, okay, I don't care about the quality of a company. So long as they have other characteristics which are favorable for me, I can get in and get out. And that's perfectly fine as well. So that is how every fund manager differs from the other on the quantitative side as well in the kind of model that they develop. Talking to the second part of your question on the arrival of artificial intelligence and machine learning. So these are terms, but ultimately, what are they trying to do? When you say artificial intelligence in investing, what it means is what an individual manager or what an individual human being was doing in terms of selecting stocks or creating rules and so on. Now the machine is starting to do the same. A machine can, there's an argument to be made that machines can perhaps develop better rules given all the data. But the problem is, I wouldn't say problem, but one of the limitations of using a system which is 100% artificial intelligence driven or machine learning driven is that the data is not, how would I put it, the kind of pattern that the data forms or follows. There may or may not be a lot of repeatability in the patterns. And there might be some extreme events which may lead to certain extreme outcomes. And the machine may end up trying to optimize for those. A human, in their better judgment, can perhaps ignore those. That does not mean that there is no future for artificial intelligence or machine learning in the industry. There, of course, is. It just means that better and more evolved models need to be made over time. So far, where we are, I think we have started to embrace machine learning in investing, but that's definitely not the be-all and end-all of how quantitative investing is. And in fact, that's just the starting point. We have a long way to go globally. In India also, it's pretty much the same space. Perhaps we are even keeping machine learning aside, we are just about starting to embrace quantitative investing, which is already popular globally. So that's basically where we are.
Sure. So let's move on to the strategy now. So one disclaimer here, that see, these are alternate investment funds and it is privately placed. So therefore, one disclaimer here, whatever we are discussing about is all for the example and for your knowledge. And the fund manager, it is the discretion of the fund manager. He may decide which stock to buy and how much to buy. So yeah, let's come to that. So can you talk to us about the strategy, the multi-factor hedge equity that you're building on, and how does the hedge works, and how does the other multi-factors, the factor that you have chosen, works in the favor of this strategy?
Sure.
Over to you.
So, like you said, there are two components to the strategy, right? So the first component is the multi-factor, and the second component is the hedge. Let's talk about the multi-factor first. Essentially, let me back up a bit and give you a context of what factor investing is all about, because that's the foundation for how the model has been built. So before 1950s, right, any investor that a fund manager generated was largely attributable to the skill of the fund manager. So the fund manager generated 5% returns. Uh, People thought, oh, great, the fund manager done a great job and generated 5% returns. The fund manager generated 50% returns. People still said, oh, great, the fund manager done a great job and generated 50% returns, right? what ended up happening was there was a lot of variability on a year-on-year basis with respect to how much returns a fund manager was generating. So there were a bunch of smart guys who looked at this and felt something is off here, because if everything is down to the skill of the fund manager, there needs to be more consistency and stability in the returns, right? It can't be 5% one year, 50% the next year, and minus 5% the third year, if it's all down to the skill. So they looked at the data, and what they found, and mind you, this is 1950. So when I say looking at the data, I'm saying it very casually, but they had to perhaps painstakingly collect and piece together all the data from print, put it down on a notepad, because there was no Excel, remember. So you had to actually write it down on a register, do calculations, which we can perhaps do now in a jiffy. They would perhaps take a lot of time to do it. They would have to do a lot of advanced mathematics to get to the solution. But keeping that aside, they looked at the data and they thought, if I actually try to attribute where the returns are coming from, what I find is that there is some common risk that these investors are taking very, very consistently. And that risk is actually the risk of the market, or the market risk. And 60% of the returns all of a sudden that the fund manager was generating was now being explained by their exposure to the market risk. And this led to the foundation of the first model in investing, which is called the capital asset pricing model today. And we use this capital asset pricing model in various ways. So even discretionary managers use something called a stock beta. And we use stock beta in our trading, in our investing decisions. But what is the stock beta? It is the sensitivity of a particular stock to the market. Or essentially, how much of the market risk is present in this particular company. That's what it basically tells you, right? So this was the first model. And once you had the first model, now people had a benchmark to compare against. So let's say your portfolio ran a beta of 1, benchmark returned 10%, you returned 10%, you tracked the benchmark well, but you did not generate alpha. Right? So now people had something to go by, something to evaluate fund managers' performance against. But the researchers did not stop there. They said, okay, 60% is explained by the market risk factor. The balance 40% also looks like a very, very high number. So can we further break down that balance 40% into other sources of risk? And that's when they came up with these sources of risk like value, momentum, low volatility, quality, and so on, and size. And they then figured out that once you had taken exposure to these different sources of risk, the overall return that a manager generated, right? 95% of those returns are now being explained by taking exposure to these particular risk factors. So it was just a reward for taking exposure to these risk factors systematically. And only about 5% was really the alpha or the skill of the manager. And that was also statistically insignificant. So like I was saying, what ended up happening now was 95% of the returns were explained by these exposures to risk. And the balance 5% was essentially what was remaining, right? And that was not statistically significant, which essentially means that on average, you would not expect a manager to generate alpha once these risk factor exposures are accounted for. Okay, so that's essentially what we are trying to do in this fund, in that we are trying to give exposure to these various risk factors. Okay, we have to remember one thing, that these risk factors, they are separate and individual or independent risk factors because they are less correlated among themselves. They give access to different types of risk, and that is where the whole beauty of diversification comes into play. They are not giving you the same kind of risk. You are not loading onto the same kind of risk if you take exposure to different kinds of factors. So that's essentially the background for why we are doing a multi-factor approach. Okay. Yeah, because it's just come back.
Yeah. Can you hear me?
Yeah, I can hear you now. Yes.
Okay. I think so. What happened is that this got logged off, and yeah. So I think the people are there. Yeah. Okay.
Yeah.
All right. We can start from there.
Okay. So, like what I was saying to everyone was the genesis for taking these risk factors is that these are diverse sources of risk, and they have been found to historically contribute to the returns of the overall investor portfolio. Okay, so these are all positive return generating strategies because they give you exposure to some form of risk. Okay, and by taking on all these risk factors in the portfolio, what you're doing is you're reducing the risk because these are all independent sources of risk which can cancel each other out. Because when something is going up, the other may go down, and the other is going down, the first one can go up, and the average impact is a much smoother curve. That's essentially what we're doing. So just to illustrate that a bit further, so most of us, right, we like want to have a long term goal when it comes to investing, that our wealth has to compound at maybe 15% CAGR or 12% or 20% or whatever that number is, right? So we have those kind of goals. And when we look at any historical data, any analysis, we look at this point to point return. And we feel very happy when someone is very successful. But when we actually start putting money in any of these strategies, what is the biggest number one problem to not realizing the past return that someone has generated in the future as well? The number one reason is that most of us as investors are behaviorally very, very impatient when it comes to staying the course, right? So the moment you see a year where there was a negative 10% or a negative 20% kind of a performance, immediately you start second guessing your decision. You start thinking, maybe did I do the right thing or not? Maybe I should not have invested in this fund. Maybe I should have invested in another fund, because at any given point in time, there is always going to be some fund which is doing very, very well, right? And we end up redeeming at perhaps the worst possible time for a redemption in a particular strategy, put into another strategy which was perhaps at the top of their cycle. And then we see the way down over there as well. So there was this funny anecdote where someone looked at the best performing fund in the US in the mutual fund space from 2000 to 2013, the best performing fund, right? And the best investor realized returns in that fund was negative. So the investor who had the best experience in that fund, in terms of the fact that they generated the best returns within that fund, they had generated negative returns. The fund was the number one ranked fund for the entire frame. Because when I'm looking at the fund performance, I'm looking at one continuous stream of NAV, that's it. But when I'm looking at investor performance, I'm actually looking at how much money the investor made. So the investor, because of their behavioral decisions, perhaps redeemed at the wrong time. And why does this happen? This happens because of cyclicality in returns. It is the reality of life, reality of equity investing, that equity markets are cyclical, right? So I just told you that the largest component of risk is the market risk, which explains about 60% of the total risk that an investor is taking. And that it's a very, very cyclical factor, or a cyclical risk factor. So it can go up or go down at any given point in time. You'll be surprised to know that there were about 45-50% of the time in the US markets, from going back from 1920 onwards, I think, for 100 years of data, 45 to 50% of the time, market beta, which is basically exposure to the market, just taking exposure to equity, would have underperformed treasury. It essentially means that it has underperformed our FD, right? Talking from an Indian context. But if you look at the entire 100-year time frame, of course, there is no chance that equities have underperformed FD or treasury or whatever in the long term. No chance. But there have been a lot of periods like these in between. There have been 10-year, 11-year, 12-year periods when your equity markets have underperformed treasuries. Not just in the US, even in India. So even in India, if you're, let's say, been an investor from 2007 until 2014, 15, whatever, maybe even longer than that, you would have actually underperformed your FD. Right? So essentially, cyclicality is something which we as human beings are not very used to seeing. So we want the best fund is a fund which has the lowest possible cyclicality. So our goal with building this fund is to try and reduce the cyclicality to the extent possible. That's our number one goal, right? So how are we doing that? We are doing that by, taking different factor exposures. Like I said, they are diversifying in nature. So the first factor which we have is a quality factor. What does a quality factor do? Basically, whenever market is in a bear kind of a scenario, whenever market is underperforming, the quality factor has historically demonstrated an ability to do better than the market. What is the quality factor? Quality factor is selecting companies which have the best quality. And it makes logical sense, right? So whenever we are in a stress time, companies which have the highest profitability, which have the best competitive power, which have the ability to pass on costs forward and whatever, are the companies which are better placed as compared to companies which are anyway very, very cyclical in nature. So this is logical. But the problem with only owning quality is what happens when all of a sudden, markets turn. Markets have bottomed and now they're turning. Of course, you expect these quality companies to now underperform, right? So you want something to have a counterbalancing effect on the underperformance of quality. So that is something like a value factor. What is a value factor? Again, very familiar to most of us, which is buying companies which are cheaper. And this could be cheaper in terms of price to earnings multiples or price to book multiples or whatever they may be. They can be cheaper with respect to other companies within their sector. They can be cheaper with respect to their own historical averages. Now, these companies have shown to do very, very well when market is turning and market is in a recovery mode. Okay. And what is the third most common cycle? It's a bull market, right? So bull market is basically something which lasts for the longest period of time. 7 years out of 10, you would expect markets to go up. You want to ride this wave up. So which is the best factor which does well in a secular bull market? Momentum. Because what does the momentum do? It essentially captures trend. So if the market itself is trending, then there is something which is trending, and what is trending keeps changing. The momentum factor adapts to that. It takes up all those segments of the market which are trending, invests in them, switches over to the next trending element, and keeps doing that. So you get returns in a trending market. So that's essentially how we are combining these factors so that they can play out well in different varying market conditions. Okay, so that's the equity piece. Now coming to the hedge piece, which is the second element. Now the market condition that I spoke about cover about 99, maybe 99.5% of all the time that an investor is around in the markets. The balance 0.5% is times of sudden exogenous shocks. What does that mean? These are times
Absolutely
when,
right.
yeah, so these are times like COVID, right? So you didn't know in December 2019 that COVID was going to be such a big thing. Even in Jan, you didn't know that COVID was going to be such a big thing, right? It was only in Feb once US markets started reacting the way they did, and then in March when there was this global meltdown, that we really saw the ramifications of what COVID could mean, and we are perhaps in a lot of places, even in our country, still facing those ramifications. This was sudden, this was exogenous, this was completely external. Similarly, Lehman going bankrupt, similar case. Russian financial crisis, Asian financial crisis in the 90s, similar case. So completely left field. You don't expect it to come, expect it to hit you, but whenever they do hit you, they hit you in such a big way that it leads to significant impairment of portfolio wealth. Right? And we did an analysis and we figured that, roughly about 55 to 60% of the entire losses that an investor makes is largely coming from these high impact events, right? So there could be a lot of these 5%, 10%, even 15% crashes from time to time, which don't account for as much as these 30, 35, 40% crashes account for in terms of overall losses in investors' portfolio. In this kind of a scenario, how can you improve your returns? So you need something that has a diversifying effect, right? So you need to invest in something which will give you that consistency of diversification as well. You don't want something which may have worked well in one crisis, but in all of a sudden in another crisis it stopped working. You don't want that, because then that will mean that you need to time it correctly, right? And timing is very difficult. So you want something which will consistently do well. So what is the solution? Are bonds the solution? Maybe bonds were the solution, but now we are all fearing that with interest rates going to go up, the correlation between equities and bonds are actually going to go up. And in these kind of market stress scenarios, maybe bonds don't do so well. And whatever data we have seen where correlations have been negative between equities and bonds has been largely from 1970s onward, which was an era of bond bull market, a 30, 40 year, 50-year period of bond bull markets, which is now changing because that was a period of falling rates. We are perhaps going to go into a period of rising rate because rates can't fall further, right? So they can't go beyond zero for a lot of time. They'll be below zero for some time, but after a while they have to revert. Maybe gold is a solution, but actually, if you looked at the performance of gold during subprime, you would be surprised to see that around gold also generated around negative 25, negative 30% returns. So that's not a great diversifier. It's good. It's better than equities. Equity generated negative 60%. Gold generated negative 30%. So it's good. It's better than equities, but that's not your idea of diversification, right? You need something positive in that time frame. Because you're not going to feel happy if I tell you, hey, you know what, I diversified, but by the way, this is negative 30% returns for your portfolio. You're not going to be happy with that. So what is the solution? What can be consistent? Actually, there is only one asset class that can consistently deliver whenever there is this kind of a shock which happens, which is volatility. Think about it for a second. What is volatility? Volatility is a measure of uncertainty, right? And whenever there is a sudden external thing which hits us, uncertainty is the number one thing which picks up, right? We are uncertain about the future. We don't know. We did not know in 2020 how long the lockdown were going to last and what the impact of those lockdowns were going to be in the short term, medium term, and long term, right? So uncertainty peaked. So what is this measure of uncertainty? It's volatility. But can you trade volatility? Unfortunately, in India directly you can't. There is an index called India VIX index, which is not a tradable instrument in India. It used to be. It is not anymore. But globally, VIX is a tradable instrument. So if you have a view that you want to express that volatility is low now, but is going to go up, you can take exposure to that fund or that futures contract. In India, unfortunately, that's not an option. So what is the other way in which you can do it? You can do it through any option by buying option or being net buyer of an option. What does that mean? Any option in the world, right? Whether it's a call option, put option, there are certain elements which go into the pricing of that option. One of them is the spot price. What is the price of the underlying? What is the strike price for that particular option? How long after is it going to mature, right? What is the interest rate? So in short term, maybe the interest rate doesn't matter. And finally, you have one more variable, which is called the volatility. So in very, very simplistic terms, the price of an option is directly proportional to the underlying volatility. As volatility goes up, price also goes up for all options, whether it is call or put. Okay. Now, depending on whether you have bought the option or you have sold the option, you can be positively or negatively impacted. So if you have sold the option, volatility goes up, of course, you are negatively impacted because you have sold it at, let's say, a price of 100 and now the price is increased to 150. Now you have to pay 50 out of pocket. But you have bought the option at 100 and it goes up to 150, you have pocketed this 50. So any option which is long in nature, which you have bought, is long volatility. So this long volatility can be expressed through a combination of options, which is essentially what we are trying to do. We are net long options in our portfolio. Why I'm saying net long is because we short certain options, but we also go long more options. The idea being that the premium we get from shorting those options kind of offset the cost of purchasing the options to the extent that we can put up like a very, very close to zero cost kind of a hedge. When I say zero cost, I don't actually mean zero. The cost could be 50 basis points a year, maybe even at times 1% a year. But that's like a health insurance premium, right? So it's something which you pay year on year. You don't expect a blowout. You don't expect to get hospitalized. But if you do, you want to make sure that the bills are paid for. That is essentially what our option program is also there for. Our option program is not there to protect you from a small fall which will require a band-aid or maybe going to a local dispensary. That's not what the option hedging program is for. It's to protect against those big ticket events. It's to protect against the COVIDs of the world, the Lehmans of the world, the dot-coms of the world, and so on. So essentially, limited events which have very high impact, we have a certain option position which will protect against those events. And because we have purchased these options which are only protecting against those events, we want the cost leakage to be very low as possible. Hence, the health insurance analogy. So we're trying to create a health insurance for your portfolio. That's what. So that's the product. The product basically combines these two things. and it offers diversification, hence in multiple different ways. It offers diversification in the style of investing, which is quantitative. It offers diversification in the different risk factors which we are taking exposure to. And it also offers diversification in the fact that there is an option overlay program which protects you from these steep falls. So that's the product.
Sure. So when you say hedging, so which instrument you going to use? You going to use options and hedge it, or how does it work?
Yeah, so we use options. We use a combination of options. We will buy certain options. We will also sell certain options. The selling is purely with the intention of reducing our cost of acquisition of options, which of course means that we will be net buyers. So we will buy more than we sell. So as a simplistic case, we may buy 2 times how much we sell or 3 times how much we sell, but we will always buy more than we sell. And we have our models will tell us what strike prices to buy these put options at, what prices to sell these options at, and so on, and when to roll over.
That's okay. So what percentage you can go up to overall if you have 100 rupees?
So roughly about theoretically we can go up to 100%, but because of various SEBI regulations and restrictions of the AIF structure, we want to keep certain leeway for extreme events. So we hedge up to 90% of the portfolio.
90% of portfolio is hedge. So my question is, don't you think this hedging the portfolio adds up a lot of expenses
Exactly. So
and
exactly. So
reduce alpha? Because
hello. Yeah, exactly. It does.
yeah,
Now the question is, what is the amount of premium you should be willing to pay? If it is 2% a month, you shouldn't pay it because on average equities are returning 13, 14, 15%. If it's 2% a month that you're paying as fees, then you're effectively generating 2-3% a year, maybe slightly more because sometimes the options monetize, but maybe 6% a year is what you generate best case. You don't want that, right? Because you don't want to give away half of whatever you're earning for hedging. You want to give away a much smaller portion, which is what our endeavor is. So our endeavor is to keep the cost of hedging on average to about 50 basis points to a percent per year. Which does not mean that on any given year you will only face between 50 basis points and a percent. It just means that on average that is the percentage range that you're going to get. There'll be some years where you don't pay anything. There'll be some years maybe where you pay 2%, but on average this is what you'll pay. So 50 basis points a year, and hence I said it's like a health insurance. Health insurance is the premium which you're paying every year, right? You're not paying the premium because you want money from the insurer. You're paying that because you want that protection or safety that in case you get hospitalized by your unfortunate whatever time you get hospitalized, you want a compensation. You want to make sure that there is someone who's willing to pay me for whatever procedure I'm doing in the hospital, no matter how complicated, no matter how straightforward. That's essentially what it is.
saying essentially the internal target is not to spend more than a percentage or a two at yearly and not monthly, right?
Yeah.
Okay. So maybe around 0.5% to 1%, depending upon. So you think with these expenses you can hedge 90% of the portfolio, looking at
Yeah,
the
because see, basically there are trade-offs at everything, right? So the trade-off that we have here is that we are not going to protect against. So when you say hedge, you have to be very careful with what you mean by the word hedged. Our portfolio is not out there to protect your portfolio from a 5% fall or even a 10% fall. That's very clear, right? So there will be a lot of scenarios where, so for example, in the first 6 months of the year, the market fell by around 15%. It subsequently recovered, but peak to trough was 15%. My hedge is not even structured to protect against that 15% kind of a fall. Okay, because in my mind, that is not a tail event. And that is what the market also believes. Because if you look at the volatility levels of the market, it did not even cross 30 even months. Even at the peak of Russia-Ukraine crisis, the maximum VIX level was around 30 point something, which it significantly corrected back to the 20 levels, and now it's below 20. Right? Despite the uncertainty, despite everything, market and collectively market participants don't believe that this is a tail event. This is something which has been a narrative which has been around for more than a year now. From 2021 onwards, people were talking about inflation and the problems of inflation. It is just that the numbers actually started printing only in 2022, right? And as the numbers started printing, the segments of the market which were the most overvalued started re-rating. That's essentially what happened. This is not a tail event. So my hedging program is designed to protect against tail events. So there is a clear trade-off. It is not designed to be a capital protected fund, because there can be a 5%, 10%, even 15% fall every now and then, which my derivatives hedging program is not designed to protect. It is designed to protect a tail event, right? And that is the trade-off. And because it is protecting only those certain events, my cost is also lower. If I had to protect all the events, my cost would have been higher. That's the reason for why the cost is low. The reason
So
is
as
not that I am doing some, very, very active management on the hedging and I'm doing something which the rest of the world can't do. It's just that I'm choosing my battles. I'm choosing the battles which I want to fight.
so does your structure allow you to monetize and exercise these options at times?
Yeah, so our monetization program is, we try to be close to delta hedged as much as possible, which essentially means that the monetization is a feature of the rebalancing itself. So, of course, we don't delta hedge on a daily basis because that will imply too much trading costs and too much brokerages to be paid out and taxes to be paid out, which we don't want to do. So, hence, it is not that tightly hedged, tightly delta hedged. But the delta hedging resets maybe once every 2 weeks or so. So there is an automatic monetization of the option that is happening. So I don't need to, think of when to monetize, when not to monetize, because the delta hedging takes care of it automatically.
And the other question is, because it is multi-factor, you think the churning in the portfolio would be slightly higher than your vis-a-vis other
100%,
port-
100%. So these days, actually, we are starting to see mutual funds and even PMSs churning portfolios to a much greater extent than what they were churning earlier. Uh, your average mutual fund is churning their portfolio by about 50 to 60%. Earlier, that ratio was much lower than that. Our portfolio churn is about 130,
100% these
140%.
days.
So
Yeah.
our churn is 130, 140%. So we are maybe 2 times or 2.5 times the average portfolio churn.
So, so which are the broadly based few multi-factors that you just want to highlight, just to name them for the benefit of our viewers?
Sure. So the uh, 4 factors which we look at are quality, which is the premium that a high quality company is perceived to be safer than a low quality company, and perhaps the other way around is more important, that you don't want to be invested in a junk company no matter how attractive they look, no matter how much momentum they have. At the overarching philosophy. Second, we look at low volatility. Low volatility is again very similar to quality in a lot of ways, but it's a market based metric. It's a statistical metric. It's not a quantitative or it's not a fundamental metric. Meaning quality of a company can be gauged by their financial statements. Low volatility is something which is gauged by the price action of that particular company. Okay, so but they are trying to tell you similar things. Then the third and the fourth factor are interesting: momentum and value. They are actually not opposite ends of the spectrum at all points in time, but typically they tend to be, at the two ends of the spectrum. Value is basically investing in companies which are undervalued. Momentum, on the other hand, is investing in companies which have the highest trend. So from first principles, also they are two ends of the spectrum, right? Because one is going up, the other is gone down. So other is actually not in momentum. The first one is in momentum. We are trying to take both these flavors in our book. That's essentially what it is.
To manage when you talk about quality, and on the other side you look at value, and not necessarily at times that value stocks are supposed to be quality. So
100%.
you are
So for
expecting
us,
turn around, yeah.
yeah. So for us, quality is more like a filter rather than a ranking mechanism, right? So we don't want to operate in that segment of the market which is low quality. We are very clear about that. We only want to operate in that segment of the market which is above average quality. So that is how we are using quality. We are not using quality to, uh, rank companies and then separately rank companies based on value and then take an average. That is where the problem will be, where the companies are completely different from each other. We are looking for relative value within a bunch of above average quality companies. So we are looking at companies which are undervalued from this bunch of high quality companies. We are not looking for undervalued companies from the entire opportunity set. That's the difference. So our companies can be on an absolute basis, they can still look overvalued because there will be a lot of duds out there which are looking much more attractive from a valuation standpoint than the companies which we choose. But from the list that we have, which is our high quality list, these are the most undervalued ones. That's the way we would look at it.
Okay, so we are running short of time here. So if any of the participants, if they have any question, please type in your question in Q&A box or maybe in the chat box. I'll take them one by one. In the meantime, so Shankar, is there any percentage which is defined amongst these four major parameters, the factors, or
So
you are flexible to move from one to another?
no, not flexible because these are more strategically defined. Uh, so we don't see the value add in actively timing how much allocation we want to give to each of these factors. That's although in full honesty, that is something that is an area which is of interest to us. We want to see if we can generate additional alpha by also actively tweaking the percentages. So we are working on that. So far, the evidence is not conclusive. So we have kept it out of our model for now. That does not mean that in future we won't deploy any other. So that's also quantitatively defined, by the way. So there will have to be a model which tells us that in this regime, uh, first of all, it has to define the regime, and second, it has to say, okay, in this particular regime, value should be overweighted as compared to momentum and quality. So we have to build a model like that. Right now, we have not found sufficient evidence that whatever model we have built to time these factors have really resulted in much better alpha or superior alpha as compared to strategic allocation. So that right now our allocation is strategic. Over time, if we are confident enough in a switching model, we will deploy it. But for now, we are not thinking about it. So when I say for now, for the next 6 months at least, we don't see uh, our models being more tactically allocating to different factors. They will continue the strategic allocation.
What if your system suggests that the momentum strategy suggests you to consider looking at Suzlons and Yes Banks of the world?
Very
Before
difficult to get those because, like I said, our first level of filter is quality, right? So we look at companies with above average quality. And for us, quality is long term quality. And by long term, I mean the last 8 to 10 years of quality. So a Suzlon or a Yes Bank or any other stock in the world, which is a crisis ridden company which has a lot of corporate governance issues and so on, the fundamental numbers themselves are not going to be favorable or amenable to start including them as a above average quality company. They are perhaps the worst quality companies to be invested in because they are A, extremely cyclical, B, have also gone through some turmoil in their operating businesses, because of which their profitability numbers are all over the place. Perhaps they're not profitable. That's why they've gone through all these problems, right? So those companies, the chances of these companies coming into our consideration list, even leave alone momentum and valuation, but even in our consideration list is extremely remote. I'm saying extremely remote and not 0% because some stray company can still come in. We Our model and the parameters that go into the model have been defined in such a way that we try to eliminate every single case like that. But it's there can still be a company which comes in. We don't know. We can't say that for sure. But at least historically, when we tested this model, even at the times when Yes Bank was not troubled, even at the times when Suzlon was actually going great guns, we never got those companies in our consideration list. Leave alone portfolio, even in our consideration set, we never got those companies.
what would be the beta level of the portfolio? Was the
So we are
question.
running a zero point 0.6 kind of beta, zero point 0.6, zero point 0.7 kind of beta.
Oh, I mean, is it because of you hedging the position? Is this
So
reducing?
in a normal market, the hedging does not really contribute much positively or negatively. So essentially, whatever returns you're getting, it's or whatever correlations you're seeing are largely a function of the portfolio constituents themselves. Uh, but when there is an extreme event, of course, the hedges will contribute, and that will further reduce the beta. But the 0.6, 0.7 beta that I'm telling you, even after COVID, even after you remove the impact of COVID, we pretty much run it at that beta levels only. So 0.6, 0.7 is basically our portfolio beta, which essentially means that our portfolios are more conservatively built. They don't have exposure to the high beta names so much. Our banking and financial exposure is very, very low. And our active share is very high. So if you look at our portfolio versus the benchmark Nifty 50, Nifty 500, we'll be running an 80-90% active share kind of a portfolio. So our portfolios are actually very different from that of the benchmark.
And the next question is, will you have exposure to futures also?
So currently, no. Currently, we have only options and cash. So futures, we don't want to hedge using futures because they limit the upside, which we don't want to do. So that's essentially the reason. Maybe, I don't know. I don't see any futures inclusion in the foreseeable future.
What would be the essential breakup between large cap, mid cap, small cap? Of course, your system will generate, but how has been your
Yeah.
observation?
So on average, historically, our large cap exposure has been about 30-35%. Mid cap has been 50-55%. Balance 10-15% has been small cap. But by small cap, for us, small cap means the 300 company, not beyond 300. So 250 to 300 is the small cap universe that we look at. We don't go beyond 300.
And what would be the Sharpe ratio like?
So the fund is very recent to actually look at a meaningful Sharpe ratio. On historical basis, I think it's a decent number, but I don't want to, I can share the number, but the problem is I don't want people to get wowed by that number and say, okay, this is a great fund and I want to deploy all my savings here. Hence, I want to run that disclaimer. But so we ran lower than market volatility. So market volatility was about 16-17%. We ran 14-15% volatility. Market returns were 13-14%. We ran, I'm talking about historical backtested data, we ran close to 29-30% CAGR. So we ran double the market returns at lower than market volatility. So basically that's how we would look at Sharpe. But I would again make the disclaimer, don't make your decision or base your decision to invest or consider this only because you think you looked at the historical returns and you found the returns to be great. Because that is backtested data. So that was at a time when these factors were not around. Today factors are around, and 5 years hence factors are going to be around even more. These kind of strategies are going to start trading more and more popularly in India. So the chances of generating the same outsized alpha that you generated in the last 10 years is much lower, right? You'll still generate alpha, but if you go in with the expectation that I want 10% alpha, 15% alpha, that'll be a difficult task. And we want to make sure that the investor experience is as good as we can promise. So hence I want that caveat to be out there. So look at this from a diversification perspective. Look at it from the point that your portfolio perhaps does not own the kind of companies which we are owning. Look at it from the point of view that we own different risk factors which your portfolio may not be owning. Look at it from the point of view that we own the hedging piece, which is most likely not there in your portfolio.
So what sort of returns are expected, or I would say historically, how has been the returns? I mean the patterns, and number one, and number two, what sort of alpha historically this kind of strategy has generated?
So let me take it slightly differently. Let me take it from a global context. Globally, because these factors are more popular globally, how have they reacted globally? So globally, whatever your market is returning, right? On top of that, these factors have generated about anywhere between 2 to 4% per annum additional returns. I would think that because I'm actively managing a model which is turning out this portfolio, and I will keep making improvements to the model to make sure that that model is as relevant as possible. Maybe that leads to another 1% alpha or 2% alpha. And finally, if the hedging comes into play because there is a tail event, that may add to some good 3% alpha to the overall annualized returns. So if you just add up all these things, if you think that the market is going to return 12%, you can look at some 7% additional returns on top. So about 18-19%, I would say. Sorry, I couldn't hear you.
Is an open-ended AIF, right? So
this is an open-ended AIF, yes.
you're not closing it in near future. I mean, you don't.
No. So there's this fund will run perpetually. The idea is, this is that kind of a fund which, it makes sense to have this kind of a strategy throughout, and not time it because it's not relevant only for the next 3 years and then it stops being relevant. That's not the case.
So there's no drawdowns. I mean, this is from an investor point of view.
Yeah. There's
We
no
have to-
so because it's an open-ended scheme, there's no provision for us to draw down money in tranches. We have to draw it down in one shot. Of course, that doesn't mean that. Uh, we can't draw down if you are investing more than a crore. So if you are investing more than a crore, of course, only the first 1 crore has to be deployed in one shot. The remaining portion can be drawn down.
investor needs to decide if he wants to continue for next 5-10 years in the strategy. He or may is allowed to continue. Is that correct, or that there's any?
Yeah. You can keep continuing as long as you want.
Yeah, Amitji, for your question, you're right. So with 0.6 to 7% beta and the hedging expenses, what we talked about, in the tune of 1% to 2%, depending upon how the market behaves, what they're expecting is about 18-19% CAGR. This, but let me one disclaimer here. This is just a calculation what we've discussed for the example purpose. There are no commitments as such officially, and we'll have to discuss this in one-on-one. But what you're saying is right. What you've written is right. All right. So with that, we'll conclude the session here. It was pleasure reading your mind, Shankar. You bring about a lot of data points for us to read and understand. This is something which is building up in India, as you rightly said. Globally, it's very famous, and the whole idea was basically to understand more in detail. So, thank you so much for sharing your insights on this subject, and we look forward to have more interaction with you.
Thanks a lot, Vikas. Thanks all the participants for joining in. It was an absolute pleasure. When I came into the presentation, into the webinar, I wasn't sure if I had to present, but the way you kind of conducted the whole thing, I thought it flowed very logically, and exactly whatever I wanted to communicate, I hope came out in the same flow that I wanted to. So
Oh
thanks a lot for
yes,
that.
yes. Especially the data that you talked about globally, how it works. See, one is that strategy discussion. The other one is for us to be able to build the background and the context. For
Right.
our investors to get educated about these strategies. So we organize these these knowledge-based sessions more often, and the whole idea is to basically educate, and empower our investor community as well, irrespective of they deal through us or not. So, thank you
Right.
so
Right.
much for taking the time out.
Absolutely.
Thank you, everyone. Bye. Take care. We'll see you next week. Thank you.
Thanks. Bye, everyone.